We may have seen the peak in inflation, but not for the reason that we're hoping for. We just had thousands of new layoffs announced today from Tesla and Novartis. So some of the biggest companies out there are starting to get hard. We're going to talk about those layoffs, how it could impact consumer spending overall. We just had the consumer sentiment report. We're going to pull that up and see how consumers are feeling about the market right now and over the next 6 months. And we're also going to tie that into the ETF trends for markets over the past couple of months, because there's some concerning trends going on with retail that ultimately means that the market could be bottoming. Let's do a quick market recap. We had 3% down day on the NASDAQ, consistent selling. We had a bit of a spike in the morning and then just a sell-off all day long, big selling at the end of the day, as I think people are selling and positioning overall for Jerome Powell speaking later in the week and also inflation reports coming out later in the week. We had the S&P 500 down 2%. The Dow Jones down 1.5%. One of the most concerning things that I'm seeing right now in the markets is that we're finally starting to see big sell-offs in large cap growth companies. So companies like Apple, Microsoft, Facebook that have been resistant to the sell-offs that we've seen from other smaller companies, the unprofitable companies with just a business plan and a dream that are down over 80% on the year. They had been largely held up by the companies like Facebook, Microsoft, and Apple, but those are finally starting to see sell-offs as well. So we had large cap growth down 3% on the day, leading the charge down. Now, I mentioned that inflation peaked. This is one thing that I want to take a look at. And keep in mind, if you're watching this channel, you're one of the lucky individuals that likely owns financial assets. 45% of Americans own no assets. So they really don't care how the stock market is trading. They care if they have enough gas to get to work, how much food costs, how much their energy bills are. And we're starting to see a bit of a reprieve in each of those. So we've had Brent crude now down 1% on the month. Doesn't sound like a ton, especially after the run-up that we've had, but it is easing. We're not seeing those consistent increases in prices. Gasoline's down 2% on the month. Natural gas is down 25%. We've got the metals that go into things like constructions. We know that companies aren't building new buildings. The high rises have stopped construction. If they had plans, they've been pulled back. Consumers aren't building new houses because interest rates are too high for them to be able to afford, and they don't know what they'll be getting by the time construction's complete. So we've got metals like copper and aluminum that would go into construction down 12 and 13% on the month. And then we've got items that go into producing food like wheat, soybeans, corn, and cotton down 20% on the month in some cases. So overall, very positive signs that we may have seen the peak of inflation, and that means that potentially the Federal Reserve can back off of some of their extra increases to the prime rate, and potentially that could send us in an upward direction for the market, or at least stop a lot of the bleeding that we've been seeing. If we take a look at the S&P 500 heat map here, we can see that Microsoft and Apple were down 3% on the day. Google and Meta down 3.5% and 5%. Amazon and Tesla down 5%. So a lot of the companies that had been holding up the indices, maybe not Tesla, but most of those others had been performing relatively well in the market, and we're now starting to see those selling off, while we've got energy, healthcare still performing somewhat well, and utilities, as I mentioned in the past, are very inflation proof because they just raise their prices with inflation, potentially more than inflation, and pay out returns on investment. So investors are still fleeing to these energy commodity stocks as well as utilities and healthcare, and that's ultimately propping them up, but that's sucking money out of the large cap growth companies that still have a long way to fall, in my opinion. So we can see here that on Tuesday, the Conference Board's Consumer Confidence Index dropped to a 16-month low of 98.7, while it was expected to drop to 100 from a revised 103 in May. This lowest reading in 16 months coincides with basically the middle of the pandemic. So consumers are back to not feeling confident about the way that the market's going to be trading. Now, keep in mind, this is the Consumer Confidence Index, not the Consumer Sentiment Index. Consumer Sentiment Index is more like, how do you feel about the overall economy? While consumer confidence is basically just associated with the market. And consumers don't feel confident at all that the market is going to continue its uptrend that we had seen over the past couple of days. And we saw the market give up essentially a lot of the gains that we had gotten over the past couple of days. So the consumers may be right here. And we'll talk a bit later on about what they're doing ultimately to position for that. So we just saw today that Tesla announced a layoff of about 200 of its autopilot workers. also rescinding some offers. So more than 200 jobs affected here, but 200 specifically already in play jobs were pulled back from their team. Now we know that Elon Musk has mentioned that as much as 10% of the salaried employees of Tesla need to go. So this 200 is ultimately not a big push towards the 10% that Elon Musk is looking for, which means a lot of these will be coming down the pipeline. Tesla has about 100,000 employees globally. Not all of those are salaried employees, but he could be inferring that up to 10,000 employees ultimately need to be laid off. We just saw 200, and these are autopilot workers, which means they're probably highly paid, highly skilled individuals. Again, $100,000 plus jobs are just going away. They're the easiest to cut. They can bring in new workers at lower salaries. And now that we're starting to see the unemployment rate tick up and other companies laying off, we'll start the cycle again of being able to not have to offer insane salaries in order to attract workers, because they'll be happy to just have a job at all. Same thing with Novartis here. This is a huge layoff. Novartis has cut 8,000 jobs under their new CEO shakeup plan. Now, it's important to note that they just recently got a new CEO just about a month ago, and they are looking to cut about $1 billion in expenses. But this 8,000 positions is out of 108,000 employees, so a fair cut, just a bit over 7% of their overall workforce. Of course, CEOs come in, they want to make changes, but I don't think that this is just CEOs looking to make changes. I think it's overall a general trend that we're going to see in the market over the coming months, with large paying jobs being cut, trying to bring in cheaper workers, and doing anything they can to ultimately help margins. Because keep in mind, during periods of inflation, no matter who you are, your margins are being crushed. And so ultimately you look to start shaving some of these expenses. Overly paid employees that you could potentially lay off and bring on new employees at lower rates are one insanely easy way to bump up margins, to continue pushing your stock forward, because ultimately that's how a lot of these executives are compensated, is with stock options that are predicated on their stock being up year over year. And if it's not, and especially in a bull market where it's not likely to be, extreme measures have to be taken. So I think we're going to continue to see these layoffs. Nothing new there, but it's just important to note that how quickly things are happening, that even companies like Tesla and Novartis, some of the biggest companies, highest profit margin companies out there, pharmaceutical has insane profit margins, are laying off already. Now, one important thing that we want to take a look at here towards the end of the video is how investors are feeling about the market overall. We just talked about how consumer outlook is at a 16-month low. Consumers are not feeling confident about the market at all, and we can see that with $10 billion in ETF exits over the past month. In fact, if we take a look down here, the S&P 500 jumped 6% towards the end of last week with an insane rally, leading a lot of people to feel like it was the start of a new rally or potentially a bear market rally. And a lot of people took that overall as a sign to go ahead and get out. So we can see here this chart from Bloomberg. We had $10 billion in ETF outflows at the end of last week, which marks one of the largest outflow periods in years. In fact, if we take a look back at the chart, we can see here that going back towards the beginning of the year, people were buying in bulk. In January, March, May, that ultimately signals how investors were feeling about the market. Basically, every small dip was being bought up. Now that the market's continued its trend downwards, and now that consumers aren't feeling great and CEOs are coming out and saying, hey, we're not going to have the margins that we had previously said. Advertising spend is down. Margins are down. We've got high inventories. Now consumers are starting to pull their money out of the market, but we know how retail trades. We know that they tend to sell at the bottom and buy at the top. And some of it's not their fault. If you think about it, when we've got maximum employment, when everybody's got a lot of money and money's just sloshing around, people are buying investments. They're investing in their 401k at the top of the market. As the market starts to turn around, we see what happens. We've got layoffs in the thousands of people. So people start pulling their money out of the market after it's gone down. They stop investing. So overall, if you think about it, a lot of people talk about, hey, the market returns 7 to 10% on an annual basis. But that's if you're consistently dollar cost averaging into the market, which I would recommend that you continue to do during this time if you have the ability to do it. But if you think about it, Consumers can't do that because of the way that the economy works. And when we're seeing the times where you buy the dips and ultimately get the larger than expected returns, or when you could get the larger than expected returns, is when you're seeing the layoffs and people losing their income and ability to do that. So overall, a lot of interesting things going on in the economy right now. Outflows out of ETFs lead me to believe that potentially the market could start turning around. We may have seen the peak of inflation as more and more workers start to get laid off, especially in higher paying jobs. I think we start to see a consumer sentiment towards people putting their money into savings, not spending it, not buying extra articles of clothing, not going out to eat, not buying fancier cars. Automakers have already mentioned that even repo rates are going up. So there are a lot of things that are slowing down that lead me to believe inflation may have peaked. That means that we may see the highest inflation reading this coming month, but then in subsequent inflation readings may see that coming down, which means that we could also see the Federal Reserve back off on some of the increasing increases in the federal funds rate. And if we see that, that means that we could potentially start to see a bottom in the market and a slow grind back upwards. But let me know your thoughts. Do you feel like we've seen the bottom yet, or have we seen the top in inflation yet? I'm always curious to know what the audience is thinking. If you're new here, don't forget to subscribe. And if you've watched all the way until the end, I really appreciate it. Don't forget to leave a like on the video. Catch you in the next one.